Hi guys, welcome back to TradFi and Bitcoin Club. So the topic for today is basically orange juice. It's an initiative taken by Lynn Alden and like Ego Capital. So people like Lynn, Jeff Booth, and basically they are partnered with Ruben. He's ex Navy SEALs, and then he transitioned his career after military into finance. So they both are joining hands, and basically they are forming Orange Juice, and it is similar to a private equity fund, but it has like Bitcoin's maybe you can call it ethics or ethos in this fund. And yeah, that's about orange juice. So let's start now. When I talk about private equity, or let me start from this. So this slide says who will care for this after me. So imagine a founder who is running a business in your local, like in your locality. So these private equity funds are very famous in the US, and sometimes these funds also do some leveraged buyouts. So they also sometimes buy out a publicly listed company, turn it into private, like fully reform that company and then relist that. That is a different like strategy. It is called as a leverage buyout or LBO, but this is something different. So in this category of private equity, they generally look into like cash flowing businesses which have matured, like they have entered into like a maturity phase in the business cycle. So they do not have any growth perspectives, but like they are generating a good load of cash flows. So to be specific, for this fund they are looking to like to buy or to invest in in businesses which are having $1 million to $10 million of like cash flows in a year. Remember, these are cash flows, not revenues or not earnings. These are cash flows. So uh, things are different when you talk about cash flow, when you talk about earnings, when you talk about revenues. So understand this from a cash flow perspective. Like literally, your business is getting that much amount of cash, and that cash is sitting idle in a bank account because that business has no way to, basically it has very less growth opportunities. So think of it as a, let's say, let me take an example of a jeweler. I'm purposefully taking an example of a jeweler because in general they have like higher revenues and higher cash flows. So bear with me. So let's say you have a jeweler, let's say in your town, and that jeweler is earning, let's say, $1 million every year in like in cash flows, and this will continue for foreseeable future. So this is the perfect example of a business which these private equity or specifically this private equity fund is looking to buy. So, this business, what is the difference between, let's say, a local jeweler and a PNG or Kalyan Jewelers or XYZ, which is pan India? So, when you are dealing with a local jeweler, you have like relationships with a local jeweler. He understand what is the local taste of the audience. He will not like make jewelries um, which maybe are selling pan India, but every business has a local taste. So some design of a jewelry might be getting sold in, let's say, my hometown, which might not be selling in Mumbai or Pune, or which might not be selling in Delhi. This kind of business, which is making revenues in millions, sorry, cash flows in $1 million per year. So this kind of business, and on top of it, the business is run by an audience or the people with demographics who are nearing to the retirement age. So after them, there is nobody to take care of because their son or their daughter is somewhere like sitting in Germany or sitting in USA, and they are trying to build something of their own. Now, if you value this business, this might be like worth in multiple crores, but it is illiquid. Like, this business is illiquid. The only liquid part that this business has is basically the cash flow that is coming in every year. Now, what if a founder wants to like give away some part of that business, or let's say 100% of that business, and enjoy some liquidity in his like retirement age? So that is the purpose of like private equity fund to enter in. Now, when coming to the second slide, success creates a new kind of risk. What does this mean basically? So, like, usually we hear the story of entrepreneurship going from zero to one, the idea, the risk, the first customer. We speak less about the other end. A successful company, when it, or a successful business, let me not name it as a company, let me purposefully name it as a business. It becomes larger than its founders, than its employees, than its customers, craft, and culture. Yet, the ownership decision remains concentrated in one person. So basically, who is basically the family or the person who is running it. But what if the family does not have any higher, any basically his legacy is um, basically his sons and daughters are not willing to like carry forward the business. They are doing something of their own, or the business do not have any hair. So in this case, there are cases where family does not want it, like, or they want to enjoy liquidity, or management may not be able to finance something for the business, or let's say if a strategic buyer comes in and they like erase the total business, and that is not what the family wants to. The family still wants to like, even if they are holding a small portion, or in some cases what happens if the family wants to enjoy liquidity, and the fund or the PE company invests in this company, then what happens is a leadership position is given to, let's say, the founder, or a board position might be given. So these things can be done in these types of deals. So, ownership, the risk that I wanted to talk about in traditional financial PE funds, what will happen is basically a TradFi PE fund will buy out this and revamp the whole business, uh, and they will try to optimize cost, somewhat leverage it, and after doing that they will try to like basically make it much more profitable, much more operationally efficient. But in this process they will lose the local touch, they will lose the personal touch that the founder has in a business. And basically, I will come into private equity in detail, but yeah, this is what about the ownership risk. In this, basically, whenever a founder exits, uh, the 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 life, or what I can say, the soul of that business is basically being killed, or the style of that business is basically being killed for operation, for making it operationally much more efficient and generating much more cash flows, and making it much more profitable. So this thing gets killed by like these kind of funds. Now let's come to private equity. Now I will talk about like traditional private equities which are there in the market and what's their aim to achieve in this kind of fund. So as you can see, a PE fund is a temporary pool of investor money. So this is a pool and different kinds of like different types of investors pool in money in this A, B, C, D, E, F. So all these investors pool in money and let's say there is some 40 million. So in this orange juice case, they have raised $40 million. And this 40 million is then deployed into, let's say, to buy a business. Then they need to improve, they have to make it operationally efficient, and in 4 to 7 years they look to exit this business. They might exit by doing SME IPO, or they might exit by doing, let's say, by selling it to someone else. There are a lot of ways where through which like they can sell. So this is somewhat about private equity fund. If I have an example, so yeah, so I will also talk about, in some sense, an LBO in private sense. So let's say a PE investor invests $12 million of equity in a business, and basically that business is valued at 30 million. So out of, if I have some space, okay, I can do it here. So let's say there is a business and that is valued at $30 million, and the PE fund puts in $12 million in equity, and rest of the money is borrowed as debt. 18 million 18 million is borrowed as debt. So how are the costs of the debt are funded? Basically the business is generating cash, right? So that cash is being funded by basically this debt is funded by the cash flow which the business is originally generating. Now, with this, let's say after 4 to 7 years, the business is doing good, and like they are able to find a buyer at, let's say, a valuation of 50 million dollars. And in the 4 to, let's say, let's take 5 years time period, and in this 5 years time period debt has reduced. Equity remains basically 12 million, debt has reduced to, let's say, $8 million debt, and the business is now valued at 50 million. So debt has been paid, like $10 million is paid, and the business has been valued from 30 to 50. Now the equity will now rise in this business from 12 to the remainder. So 50 minus 8, 42 million is now your equity. So you will that fund is generating around some 28% of CAGR through this transaction. 28-29% of this of CAGR through this transaction, and they have essentially like 3.5x their money. And this is basically what traditional PE funds do. Now let me also talk about, I have talked about why founders sell to PE, but let me also talk about in detail. So most of their wealth is tied in one company, so illiquidity. Then they want to retire or reduce their responsibilities. So let me give you a fact. There is trillions of dollars of these businesses, cash flowing businesses in the US, and the demographic is such that these businesses are being run by, let's say, people in their 50s, 60s, or late 40s. So these businesses need, or the people who are running these businesses need to have some liquidity because they want to spend time with their children are or their family, whatever. They want to enjoy their retirement life. The some other things that can be thought of is basically management is not able to finance internal purchase. So because what does this mean? Management is not able to finance internal purchase. This means that the company is generating cash flow, but that is not basically able to finance internal purchase. So founder can get liquidity through cash flow, but it is not enough. Then the company needs professional systems. So what does this mean? Now, when you compare a PNG to a local jeweler, you might see a lot of difference. So when you go to PNG, they have systems and processes. So PNG, when it came and it started to expand, there was a bad practice in India, which basically what it means, like they jewelers sold 22 carat or 18 carat gold, saying that it's 24 carat gold, but this was not true. So, in this case, to bring systems and processes in the business, like this might be one of the reason. Then the founder might want to remove personal financial risk out of it. They believe a larger owner can take the business further. So there are things. So there are people who are good at 0 to 1 and 1 to 10, but 10 to 100 they are not great. So with um, with these local businesses, they have done 0 to 1. Some might have done 1 to 100, 1 to 10. But now the founders of this business might think that if some larger owner or a person with larger capital can take the business further, then the business can scale to much larger level. Remember, I am talking about traditional PE funds and not orange. So I am giving you a crux of what is happening in traditional PEs, or in this whole scenario. So when, let's say, acquisition happens and so buy is happening now, in this improve stage, what is happening is basically the fund is recruiting a new CEO or a new CFO. They are improving financial reporting and doing all of this, introducing performance targets, upgrading pricing and sales processes, making technological investments. They are also acquiring competitors. So let's say an OPE fund comes in my locality and he not only acquires the biggest jeweler, but he also acquires his competitors. So like there are ways. Then they also look to centralize some functions, reduce costs, and add or refinance debt to like do some leverage. And basically leverage is the most common way in which for these PE funds to generate returns. So this is what happens. And after improving this, in 4 to 7 years, 4 to 7 years, the traditional equity funds, uh, they sell it to, let's say, another PE fund. They sell the business to, let's say, another strategic corporate buyer. So let's say this PE fund has acquired jeweler in my locality and has also acquired the other jewelers which were his competitors. Now this business has become so much structured that it is now competing with PNG. But PNG is in the end, it's a like pan India player. And but when all of the jewelers in the local market have been acquired by PA fund, now they are in somewhere near to compete with PNG. So now what PNG does is PNG gives this PE fund an offer to acquire these business. So let's say, or this PE fund pitches to PNG, hey, like, hey, look, we have improved this local jewelers business and now it's running well and good. So there is a case that PNG might acquire this. Then, in some cases, if the business does really well after improving, in some cases, IPO can happen. In some cases, sale back to the original founder. So all of the basically anyway the sale can happen, and the PE funds only objective, it's a fund, and its objective is to give returns to the investors. And also these investors look to get back their initial investment in the time horizon, let's say 4 to 7 years. So after this, they get back their original invested capital and the returns that fund generated. So this was about, I think, traditional PE. Now, I have talked about this. Founders sell for rational reasons: liquidity, succession, certainty, and capability. The modelless clock, I've also talked about this. Ownership horizon. Now, I want to come to orange juice. Before I come to orange juice, if you have any doubts still here, let me know. Till here, if anybody has any doubts.
Hello.
Yeah, Neo, go
Hello.
on.
Yeah, so I was looking at the statistic for, Subway, and Subway, a lot of these restaurant chains are owned by Roar Capital, right? In the US, which is like massive
Hmm.
PE fund. Uh, like they closed around like 600, 700 restaurants for in the last 2, 3 years. Okay. And that's like so food prices have rises, demand has decreased because they are cheaper ingredients and the optimizing, the typical optimizing that PE fund. Now I want to ask, don't they like eventually you convert the business into a husk of itself? Isn't that negative in the long term? Because you have to close stores. Sure, you increase your profit margin in the short term because you want to maximize the value. When your turnaround cycle becomes like 4 to 7 years, you have to give it to another PE fund. But doesn't in the long term, in like 10, 20 years, doesn't that make the business very, very bad, like per se?
Actually, thanks Neo for talking about this. Basically, this is the crux for orange juice, and this is the problem which they are looking to solve. So, as you were talking about, uh, a fund which has acquired Subway, they have closed hundreds of stores in the US. So this is a general trend which is observed in this PE fund. Like, these funds generate their returns, and in the long term, the business loses its value. So this has been happening with in a lot of cases. So if I remember it right, a lot of mergers and acquisitions in public space as well. Like, there's a number 60 to 70% of merger and acquisitions, like, they are not good enough mergers or good enough acquisitions in the long term. Like, in the short term, management can say this or say that, but in the long term, 60 to 70% of mergers and acquisitions are like, yeah, we could have done something better. So this is the problem basically. Orange juice is looking or trying to solve. Thanks, Neo,
Yeah,
for
I
bringing
think
that point.
PE funds are very good for owners who just want to, retire, get a lump sum amount because I think PE is very good for businesses which are super capital intensive but has very low margins but very good volume, right? So restaurant businesses and all of these other guys. But then it just, yeah, I think it's the bane of existence, like it just fucks up the quality of things in the long term, you know. Not to use
Yeah,
the
because
wrong
of
word, but it happens a lot.
yeah, Yeah,
Interesting to see
because
because
PE
I was
fund will.
also looking at the case study of P. Terry's. So P. Terry's is a business in US. It has like 1,800 employees, 50 chains, right? Which is not a lot actually for US, right? US is massive. And they have a employee ownership trust model. So they share like 5%, 10%, percentage of their this. And I think that's more sustainable when it comes to legacy. But if the owners want to retire, there is no big package, you know. So that's the trade-off. So yeah,
Yeah, yeah. True. So basically, the whole, let's say I am an investor in a PE fund. Why would I care that, um, let's say in 4 to 7 years, the fund has generated 28% returns and the investors are happy? Why would I care about what happens after that? So
yeah,
these PE funds like run these businesses very, very operationally. They make them very operationally efficient, but which in the long term it will kill, as you said that it killed Subway's long term business, and they are now shutting off 600 stores. Why would have this? Why might this would have happened? Is basically maybe the food quality has been compromised in this making of it operationally efficient and whatnot. So these are some reasons why this model is working for the fund but not working for the business in the longer run.
yeah. Very important to make the distinction. Interested in what these
Yeah,
guys have done. Orange juice. Very weird
yeah,
name though. But yeah, yeah,
yeah. Okay. Thanks, Neo, for bringing that point. Now let's come to what orange juice is trying to do um, different from what the original PE funds do. So basically, they are looking to have much longer time horizon than these PE funds. One thing is, in traditional PE funds, sale is expected. In here, a sale is not expected because the cash flows are getting invested into BTC. So the the fund will generate returns with BTC sitting in the balance sheet. I'm not yet like they have not disclosed everything about the fund, but whatever they have conveyed, we can just think about how will this fund make in money. So maybe the investors who are coming in, they are like Bitcoiners and they do not want to like disturb the business, and they just want to put in the cash flows which are coming in from the traditional business and make a balance sheet resistant to the dollar inflation that is happening. So this is one way. Then the traditional fee fund, as I was talking about, 4 to 7 year window. In here, permanent capital or orange juice, long payback investments can compound. So this is not in orange juice. Now, these things when I talk, they are in general forward-looking statements. So there might be some opportunities which um, these guys found, let's say in 4, 5, 6, 7 years, and they might also sell. There is nothing wrong in that, but the idea is not to do that. But it's not like we are not doing. We are not only looking to flip it in 4 to 7 years. The idea is not to flip, but if opportunity is there, they might. Who knows? Then debt service competes with reinvestment. As I was talking about, the TradFi PE funds use leverage. They take debt and use leverage to maximize CAGR. Then liquidity comes from selling and recapitalizing. So liquidity will come. Then in orange juice type, or what they are looking to, companies can retain identity and autonomy. So from this, what I can see is basically company can retain identity and autonomy. What this means? So in general, if a PE fund buys in, they try to remove the management, try to remove the original founders, and try to run it by their own way, because they think that we can run this business better than the existing management. But in here, they are looking to retain the original founders, and they want to help them just to get some liquidity. Then parent equity can become liquidity layer. So they are raising some $40 million in orange juice. So it is also a liquidity layer. Also, one more important thing that I wanted to point out is this is the private equity funds are kind of hedge funds. So in here, there is like, let's say they have announced that they are raising 40 million, but they will try and search businesses in the US markets and wherever, I do like whichever jurisdiction they are looking to. And if they do not find the businesses which they are looking to acquire, or which they are looking to take a stake in, the partners which I have mentioned, A, B, C, D, E, F, G, they are not liable to pay immediately their share. So their share, let's say there are 10 partners in a fund, and these 10 partners will invest or will put in money when this fund has already like found out the businesses which can be like bought in, or which in which we can purchase a stake in. So this is the thing. Now let me come to the structure. So orange juice is a company. It's a company, they are not making it a fund. So because it's a company and not a fund, there is no 4 to 7 year like time horizon for this. Now, its announcement is acquire, improve, permanently hold cash flowing American businesses. So they are targeting American businesses. Then announced launch capital is 40 million. The target for which they are looking to is basically $1 million to $10 million. And they are looking to hold, no prescribed exit date. They can exit, but there is not a date which is written in the basically documents of that company. Or so it's a company, not a fund. If the founders see to raise founder, okay. So I think these slides do not have the data about founders. So the orange juice is essentially a company which has been funded by ego death ego death capital. It is funding, let's say this is OJ, this is orange juice, and also Ruben, his surname is some, it starts with Z, but I like, uh, let's call him Ruben. So in Igodet, you might know there is Lynn, Jeff Booth, Jeff Booth, Preston Peach, and many others. And this fund is putting into orange juice, a company, and Ruben, who was running, or he's also putting in money into orange juice, and he is basically the CEO. He will be taking care of day-to-day operations, day-to-day operations of the company. He is the person who has foots on ground. So if I can, yeah. So his name is Ruben Zuiban. He's a co-founder who will be running the company's day-to-day operations as an operating partner. So his history is basically is a US he was a US Navy SEAL officer. He served there for a decade, and with 5 deployments in different places. He is a Oxford graduate. Then after doing Navy SEAL, or after being Navy SEAL officer, and if I'm not wrong, Navy SEAL is somewhere closer to what uh, like we did this operation surgical strikes. So I think the soldiers which were there from Indian side, I sorry for giving a very weird analogy, but uh, the soldiers who entered into the regions of our neighboring nation, so these soldiers are somewhere similar. So they are like very much highly trained personals and very like crazy people, very disciplined and whatnot. You might have seen them in different kinds of movies. So that is a Navy SEAL. Then, after his military career, he transitioned into finance as an investment banker at BofA Securities, and then he then entered into JP Morgan Asset Management, did research analyst and investor relations. Then his recent role was he served as a CIO of a $1 billion private multifamily office. So family office is basically, let's say, in India has various family offices. Let's say Bachchan family office, Dhoni family office. Then basically family office is something which HNIs have to manage their funds. So this guy, Ruben, was is currently a CIO, or he might be quitting this role. I don't know. So he is a CIO of $1 billion private multifamily office. So essentially, many might have clubbed into one, and he is a CIO taking decisions of different, basically how to run this family office. Then basically this is I'm reading this from the article. I'm not showing this, but let me just read it out. So the favorite part of this section of his article is basically this feature is where a lot of acquisition models get too clever. They talk about partnership, but then show up with a playbook that was written before they understand the company. They also talk about long term orientation, but then run the company against 4 to 7 year fund clock. So he's talking about private equity, traditional private equity funds. Now he talks about, I don't think sellers should accept that as a default trade. They should ask different questions. Who will be in the room after closing? Which decisions stay close to the operators? Which functions become easier because orange juice exists? What happens when first contingencies show up? Our answer is not that we leave everything alone. That would be lazy. The answer is that we are very careful about what we touch. We want to remove drag, but not personality. We want to centralize what should be centralized, improve what should be improved, leave customer relationship, product judgment, and founder DNA intact unless the facts demand otherwise. Done right, the seller should feel as if reinforcements arrived, not as occupying force showed up with a clipboard. So the last line is coming from his military background. Done right, the sailor, the seller should feel as if reinforcements arrived, not as if occupying force showed up with a clipboard. So, what he is trying to make, or let me get back to Neo's example. So, in this Subway, the fund which acquired Subway, they essentially killed the taste of that food restaurant in the process of making it much more operationally efficient. So these guys are not looking to do that. These guys, at least what they are saying. So according to them, they are looking to hold it. They are also not looking to basically throw out the existing management and run the business as I want. They are looking to have the management, have the founder DNA in the business, have they want to give the founder the freedom to have a judgment in product. They want to leave with the founder unless the facts demand otherwise. So if facts are not in favor, then they might kick in.
Digant,
So this is what, yeah,
just a trivia. I
so
mean, the most before venture funding industry came up in 2000s, 1999 with dot com boom. Like in 90s, one of the biggest industries was LBO, leverage buyouts. And the way it used to work is these operators or these financiers used to go out and take junk bonds with the help of junk bonds and with the help of cheap debt. That's why it was called leverage buyouts. Public companies by calling the shares, and they will come together. They will fire the research wing. They'll fire the workers, and then optimize that whole company to shoot the share prices up, and then they'll sell their shares, pay off the bond, or pay off the loans. There's this very popular movie, a book, and a popular movie in 90s. It's one of the like legends in this space because I used to hear a lot about this movie back when I was doing MBA. It's called Barbarians at the Gate. And basically, the parallels that this movie and this book draws from was like how Roman kingdom came to an end when barbarians started entering, and the way barbarians operate is very different from how monarchs operate, who want to have that kingdom survive for like hundreds of years in spite of all the problems and in spite of whatever they do. Barbarians have a very different incentive. They are in here to loot as much as they can and they just get out of it. So it's a beautiful movie. Like people who have time, they can watch this movie. It's called Barbarians of the Gate. Of course, like these days, I don't think P's like KKR are so ruthless. You have good examples also, like with Dell. I think Dell was a public company. It went private with the help of PE, and now Michael Dell is running it. So there are cases wherein, with the help of PE, founders have taken control of their companies too. But like, yeah, I was sharing that reference because you talked about that Navy SEAL reference, right? That I will show up at the gate, and so it's yeah, that reminded me of that movie.
yeah,
Uh,
thanks, Saurabh, for putting in much more context. I think this really helps, and especially I have not heard about what you said right now. So thanks for like paging in. Okay, so now
Hello.
coming into, yeah,
Yeah, sort of isn't this like what modern SPACs do? Like, sort of SPACs. But I had another question. So, Orange Juice is like a good PE fund, which will take care of the business. But even then, their fiduciary duty lies with the investors only, right? If they want to be a Bitcoin treasury, they have to go into businesses with high margins. They take the capital, the profit. They don't grow the business. No, they will invest that into the Bitcoin treasury, correct? Because they
yeah,
believe the opportunity cost here is proportionally better if you invest in Bitcoin. What if the
yeah.
owners don't want that? What if the owners like, okay, then they will not. Hmm.
They will not do the deal. So it's highly specific. It's not necessary
Yeah.
that they need to acquire
And
every
are they
cash
like
flowing business.
flexible? Like if it's
This
a
is
business that is,
this structure of private equity is highly flexible. Like you can put in whatever clause that you want. It's the most
hmm,
flexible thing out in finance. Okay.
yeah,
Okay. Now
yeah.
what I was talking
Because
about.
isn't that would be like active? Are they actively managing or are they like indirectly doing it? Are
I
they like
think the
actively gonna
idea
manage it?
is I think the idea is not to actively manage. The idea is to have the founder his say in this business and let give him freedom. Basically, the target for traditional PE funds is kind somewhat different. The people who are looking to completely exit, and in here the target might be somewhat different where founder still wants to run it, but he wants some liquidity. So there are nuances in the traditional PE where they want to invest, and orange juice where they are trying to do. So there are some differences.
Hmm. Thank
The
you.
the
Thank you for
strategy
answering my
also
question.
looks quite similar to what Berkshire Hathaway does. Buy
Yeah,
companies. which throw out a good cash flow, use that to invest. Except in case of Berkshire Hathaway, he would go out and look for other stocks to buy. In this case, what yeah, they believe Bitcoin's going to be a better investment than any stock. So in simple terms, it's
Yeah.
it's
So
pretty.
actually,
I mean, I
I
didn't look at
was
that slide that you had. I don't know. There's a slide which said buy right. If you want to scroll up quickly, and yeah, buy well, improve patiently. No, no, I think it went past you. Down, down, down.
this
No, just
this
just
one.
go down. No, no, no. Down, 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 down. Stop. Down, down. Yeah, stop there. Yeah. Buy well, improve patiently. Stop. You stop. Go back. Go back one slide. Yeah.
This
Buy
one.
well, improve patiently, hold permanently. That sounds like you know
Yeah.
the and then also company, not a fund.
Yeah. So basically,
So I think they
that
will
is the
list
reason why they have structured
yeah, they
orange
look
juice as a
to
company.
go public as an equity, and exit route for investors would be to sell the stock. The capital
That
otherwise
is not
is
yet
no, no,
clear.
eventually I
Like,
think.
hmm,
Eventually, because one slide up somewhere I saw, on a footnote where they said there's an intent to go public, to have a public listing.
hmm. Yeah, it maybe, but in the article, which I will share the article in here. So
So in the
it's
beginning, it
the like
will.
just getting started. So I mean, it's still a long way to go, but yeah, it makes sense to go public. And there, by the way, I was in the further slides, I had this example where I would have given the example of Berkshire Hathaway. Thanks, Winning, for bringing that in. So it's similar to what Winning said. It's basically a Berkshire Hathaway where Berkshire Hathaway will invest into a new stock, but these guys will invest into Bitcoin. So a similar strategy. So let me just finish this. So the idea is buy with discipline, durable cash flow, still has
So
a
in the
price,
beginning,
overpaying.
I have just one question. So in the beginning, is it going to be what it starts off as a close-ended fund or something like that, or
No, no, it is starting as a company.
okay, okay.
Yeah. So yeah, coming back. So buy with discipline, durable cash flow still has a price. Overpaying can erase long horizons advantage. Prove the improvement. AI and operating support must improve service throughput, resilience, margins, not just the narrative. So they will look to somewhat improve the processes, but leave the customer support, product judgment, and other things, customer relationships with the founder. Restrain the balance sheet. Conservative leverage must remain conservative when rates rise or cash flow weakens. So, as we all know, Lynn and the people who are there in here, they have excellent understanding of macro. So, they will use their expertise to when to take leverage and when not to. So, leverage is still there, but it's not like a traditional PE fund which relies on leverage. Then govern the treasury. So Bitcoin sizing cannot compromise liquidity for payroll, capex shocks, exceptional acquisitions. Uh, in here, Bitcoin, it's not like we'll have Bitcoin like always, but if we have some other opportunity or if we have some fixed costs like payroll, capex, we'll do that first. But like we'll decide. So maybe they will think that if we do this capex, will this generate an IRR or a positive NPV with an IRR of let's say 30%. If this is the case, then let's do capex. If this is not the case, let's stick with Bitcoin. So these things can be thought of. A long horizon multiplies good decisions and bad ones. Bitcoin fixed money. Now sound capital must fix ownership. So as we have talked about different examples, like Saurabh talked about barbarian case, and Neo talked about the PE funds which acquired Subway. So in these